The options you have when it comes to investing are so numerous that if you do not invest your money wisely and properly, you could lose all of it. And the highest compensation you would ever get is sorry. From NFTs to stocks to real estate, bonds, commodities, businesses, the list goes on and on. And for someone who is just getting started, especially as a Nigerian, you don't want to get entangled in all of these options. So let me make it simple for you. In this video, I'm going to be sharing with you simple steps on how you can get started in stock investing. So the whole point of investing, whether your money, your time, or your energy, is to see that it brings returns for you. When it comes to money, you are investing your money because you want it to make more money for you. Now, let's say at the end of 2023, you were able to save 1 million naira. There's a lot you can do with 1 million naira. If you like food like me, you could go to that high-end restaurant and try out that menu you've been always wanting to try. Or if you're someone that is into hairs, you can get that latest bone straight or deep weave. Or if you're a travel kind of person, you could go for that not so expensive vacation. But if you decide to delay all this gratification and save that money, well, you're not doing yourself any good either. Because what 1 million naira can afford you in 2023, in the next 10 or 20 years, it might be 2 million naira. So the best option is to invest it, because when you do, that 1 million naira could be 10 million naira in the next 20 years. Now, when it comes to investing, there are only two ways that you can make money off of it, whether you're investing in businesses or stocks or real estate or whatever. The first is through capital gains and the second is through cash flow. I'm going to be explaining this for real estate and stocks. So when it comes to real estate, how you get money through capital gains is, for instance, you get maybe a plot of land for 500,000 naira this year, and let's say the place was not so developed, but in the next 10 years, high profile people started getting properties in that area, businesses started happening in that area, so the place became more open. You can easily sell that plot of land for like 2 to 3 million naira, gaining extra 2.5 million naira, doing absolutely nothing but waiting for 20 years. So because the value of that property has increased, it automatically means that your capital too is going to increase. Then for stocks is when you get a stock at a lower price, and then maybe in the next 5 to 10 years, that stock starts doing very well and their price increases. Your capital too is going to increase. Then for cash flow, when it comes to stocks, is simply getting money through dividends. So it's like the interest they pay you for buying a share of their company. Then when it comes to real estate, let's say you got a plot of land, but you don't want to leave it like that. So you build 5 self-contains on that plot of land, and you use 10 million naira to build them. And then after building, give them out for rent, and you rented out each of them for 300,000 naira. It means that you're easily going to be making 1.5 million naira every year from those properties, and it's going to take you like 6 to 7 years to get back your 10 million naira. But when you get back your 10 million naira, for the rest of your life, you're going to be getting 1.5 million naira as rental income. One of the coolest and easiest ways to make your money work for you is by investing in the US stock market. But why should you even invest in the stock market? Well, I'm going to give you 4 simple reasons. The first is that it helps your money fight the battle of inflation. The current inflation rate for Nigeria is over 21%. That just shows how the value of our currency consistently depreciates with time. Secondly, anybody can do it. It's not so complicated, it's not hard, you just need to learn the basics. Thirdly, it is very cheap. You can start with as little as 1,000 naira. And fourthly, it has been proven to be one of the easiest ways to build wealth in this lifetime. But what exactly is a stock? A stock is a share of ownership in a company. So in other words, buying a stock is like owning a small or a big percentage of a company, dependent on how many shares you're getting. So the investment terminology for ownership is equity. So when you hear all these big investors or big businessmen talk about having 9% equity or 10% or 20% equity in a particular thing, it means that they own 9 or 10 or 30% of that thing. There are other investment terminologies that you have to be conversant with, so that when you look at a stock page and you're thinking on buying a stock, these are the things you see so that you can easily have insights as to what is actually happening in the company. First is shares outstanding. So shares outstanding is the number of stocks or shares that a company has sold out to the public. Now, WWE is a company that we all love, and WWE currently has sold over 74 million shares to the public. The next is share price. So share price is the single cost of a share. So in buying a share of WWE, you're going to get it for like $107.17, which is like over 78,000 naira. The next is market capitalization. Market capitalization is the total value of a company's share. So if we're to calculate the market capitalization for WWE, multiply their share price by their share outstanding, which is $107.17 multiplied by over 74 million, which is like over $6 million. The next thing is dividend. So dividend is just like interest that they give you for buying shares in their company. Just, it could be small, it could be big, depending on what you're investing with the company. The next is dividend yield. So dividend yield is calculating your interest in a percentage form. So WWE currently, their dividend yield is 0.40%, which means that for every 100,000 naira that you invest with WWE, they are going to pay you 400 naira quarterly, because there are some companies that pay dividends quarterly, there are some that pay annually. So it means that for every 3 months, if you invest 100,000 naira with them, they'll pay you 400 naira. And for the year, what you get as an interest, that is what you get as dividend, is 1,600 naira. I personally feel that a good interest rate is anything from 3 to 12%. Anything that is more than 12%, I tell you, run. So now that we know all this, let us get into the video. Before we get into the video, make sure you click on the like and the subscribe button, because that will show that you support the channel. So the first thing you want to do when you get started in investing in the stock market is have the right mindset. Know what you're coming into the platform for. There are some people that come into the platform of investing, and what they're actually doing is trading. So trading is buying a stock when the price is low and selling it when it's high. The investment terminology for a market that is doing so well is bull market. But when the market is doing so poorly, it's called bear market. Coca-Cola is a company that is so popular. Let's say one of their companies got burnt, one of their factories got burnt. At this point, people will be feeling, okay, Coca-Cola would not be producing as much as they used to because of this their factory that is burnt, and because of that fear, they would begin to sell their shares and get back their money. But at this time, traders see opportunities in this, so they come into the stock market, get so many shares at a very low price, and let's say in the next 2 months, Coca-Cola now build 2 more factories, and then you're having the sense of optimism that, okay, since they've built 2 more factories, it means that production is going to increase. So people start rushing and getting more shares of Coca-Cola. And we know this, we all learned economics. When demand is high, the price also goes high. So getting shares at this time, you're going to get it at a higher rate. But these people that have bought it at, let's say, $30 2 months ago, they will now sell it at like $70 or $60, and then they get their profits. But if you want to be a trader, it means that you have to be on your computer almost 24/7 to see how a stock is doing, if it's going down or if it's coming up, so that you know when to sell or when to buy. And it's not so easy. That's why I advise that if you're coming to invest in the stock market, do it for the long term. You can never go wrong with long-term investing. If you're doing it for the short term and you're trading, there's every tendency that you're going to have lots of headaches and lots of heartaches. So just be careful. After having the right mindset and knowing why you're coming here, the next thing that you want to do is to get a good platform that you can start off investing. And for getting a good platform, check out this video, because I have talked about 3 good apps that you can use to start investing in stocks in Nigeria. I talk about them in a detailed manner, so make sure that you check out this video after watching this one. After getting a good platform, you want to know your risk level. There are some people that know their risk level inherently, but there are some that certain things have to happen to them for them to react in order to know their risk level. There are some people that are like Dangote or Dangote's children that can lose 2 million, 3 million, 5 million, and it will not have any impact on them. But me, moi, if I lose the least 100,000, what am I even saying? The least 50K is going to pay me. So I'm very, very careful, and I'm very conscious because my risk level is low. You have to know your risk level so that you know the type of stock that you're going to be comfortable investing in. When it comes to risk, your expectations might not necessarily be your returns because there are a lot of variables that determine your investment returns. There are high risk investments and then there are low risk investments, like investing in a company like Coca-Cola that has been there for more than a decade. You know that no matter what happens, they are going to find a way to come back up. Versus investing in a startup tech company in Nigeria that maybe the management is not so good and anything can happen along the line. But if that startup does so well in the next 15 years, you're going to be making a lot of profits. There are also other risks involved with stock investing, but the one that I'm going to concentrate on is concentration risk. And this is where you put all your eggs in one basket. And right from when we were kids, we've always been advised never to put all our eggs in one basket. Hence the constant advice about diversification. Now, talking about risks, there's something I saw in the book, The Psychology of Money, and I thought to share it with you. It says there is no need to risk what you have and what you need for something you do not have and something you do not need. And I'm going to give you an example. When I started off investing, I did not know so much about it. One thing that I know that I'm not going to be actively investing in is the crypto market. Never say never, but I have this strong feeling that that's what it's going to be. But when I started off investing, I went on Instagram one day and so many investment pages were talking about this particular coin. I've forgotten what it was at that time. So I had, I think, 40,000 naira that I needed to do something urgently. But they said that in the next 3 days that it's going to go so up that 40,000 naira could probably be 120,000 naira in my calculation that time. So I said, okay, let me use this money and, get extra. So I bought that coin and I used all of that 40,000 naira and I lost everything in the next 3 days. That was me risking what I had and needed for something that I knew absolutely nothing about, something I did not want in my life and something that I did not necessarily need. I'm going to repeat it. Do not risk what you have and what you need for something that you do not have and need. That is greed. Now, after knowing your risk level, the next thing you want to know is the kind of stocks that you will be comfortable investing in. So when it comes to stocks, there are two categories. The first is growth stock and the other is income stock. So growth stocks are stocks that will not necessarily be making waves or be known as at the time you're getting them. But in the future, because they have potential, there's always a tendency that they're going to do so well and you're going to be making a lot of money from them. An example of a growth stock is Netflix and Amazon. I did not know about Netflix till like 3 years ago, but Netflix has been in existence since 2002. And here's the thing, when Netflix went public, the share price for Netflix was $1. So it means that if you had gotten 20 shares of Netflix, you would have gotten it for 14,600. And as for Amazon, when they first went public in 1997, their stock price was $18. Fast forward to now, the stock price for Amazon is like $105. If you had gotten 20 shares of Amazon in 1997, you would have gotten it for 262,800. But fast forward to now, that 262,800 will be worth over 1.5 million naira. Next category is income stocks. I call these the big fishes, the sugar daddies of stock investing. So these ones are they are low risk investments and they pay regular dividends. Under these two categories, there are different types. So there's individual stocks, there's REITs, there's ETFs, there's mutual funds, and there's index funds. So I'm going to be explaining this one by one. But before I go on to do that, click on the like button because that will show that you support the channel. Individual stock is like buying an X amount of shares of one particular stock. And this is a very high risk investment, except you're going to be buying like different individual stocks. This is also an example of concentration risk. So this is like, I believe as if you're in Nigeria and you know yali bread, it's like buying a carton of yali bread. It's only yali bread that is going to be inside that carton. So all your money is going into getting about 15 or 16 yali breads. The next is index funds. An index fund is a basket of individual stocks. So this one gives you different stocks, but all these different stocks are under one stock. An example is the S&P 500. The S&P 500 tracks 500 companies in the United States that might be doing so well or so bad, you never can tell. But either ways, it is safer because this way, when one stock is doing poorly, the other might be doing great. So that way, you do not lose all your investments. Explaining the index funds in a layman term is like that yearly bread now that you got, the carton of yearly bread, there's like 20 now, right? So everything inside that carton is yearly bread. So if it gets spoiled, if one gets spoiled, there's the tendency that the rest is getting spoiled because they have the same expiry date. But if you now decide to go for an index fund, it means that you can buy yearly, you can buy Sweet Father, you can buy Kingfishers, you can buy different kinds of bread. And if yearly bread spoils tomorrow, there's a tendency that Kingfishers will not get spoiled. There's the tendency that Sweet Father is going to be still okay. You understand? So even if you lose with one, you can win with the rest. And the next one is ETF, which means exchange traded funds. So the ETF is just like the index fund. The only difference is that this one is concentrated on a particular sector. So the index fund that I explained just before this one gives you different stocks under different industries. You can have a bit of technology, a bit of entertainment, a bit of transportation. It's just different stocks. But the ETF is concentrated on just one industry. So if you're going for transportation, every stock under that ETF is going to be for transportation. If it's entertainment, it means that every stock under that ETF is going to be on entertainment. So the only difference is that this one is more concentrated. We have REITs, which stands for Real Estate Investment Trust. So just as the name implies, it has to do with real estate. So we're talking offices, malls, apartment building, hospitals, hotels, just anything that has to do with real estate. One pro about REIT is that it is very liquid as compared to the traditional way of getting a land and maybe building on it. If you want to sell that land, you have to look for a buyer. And if you are looking for a buyer, it might take a while. But this one is very liquid. So if you're no longer interested in it, you can always sell your shares and get your money back. That's one pro about stock investing. Now that you know the kind of stocks and the categories of stocks you want to invest in businesses, look at investing in the stock market like investing in businesses. Like all these companies that you patronize from time to time, they are good ones that I feel you should invest in. So invest in companies that you know, that you love, and that you patronize. Even if you do not know about the company, here's the thing, it will not be so hard for you to do the research. I'm going to give you an example. When I started off investing, the first stock I ever got was Manchester United. This was me not knowing anything about investing. I was just excited. I went in there and the first stock that my eye came across was Man U. And I said to myself, Man U is such, a popular club. In Nigeria now, the thing about, being fans of football club is that they take it so seriously. So I felt that, okay, since there are so many fans for this Man U club, they must be doing so well. And they must be making a lot of money. So if they are making a lot of money, it automatically translates to me, that is an investor, making a lot of money. And I was so wrong, because as at that time, Man U was doing so poorly. So a share then for Manchester United was about $15, and I bought like 5 shares. But the crazy thing is that each time I went back to that stock page, it was always red. It was always down. It never went up. And after 2 to 3 months, I lost almost everything. If I was a football fan, I would have been able to do the research because it was something I love. But because football is not my thing, I saw doing the research as some sort of work. And at the end of the day, I lost everything. So like I said earlier, when I first got shares of Manchester United, a share price then was $15. But fun fact, currently, a share of Manchester United is over $20. So if I was patient as at that time and waited and left my money and did not feel like, oh, I've lost everything, let me take what I have left, I would have made profits by now. But I do not regret it because it made me learn. So what I'm trying to say is, with investing, patience is a virtue. It's very easy to buy a stock. All you need is money and the ability to click on your phone. It's as easy as that. But what is important is getting the right stock. Nobody knows what is going to happen in the next 4 to 5 years. That company you love so much, something bad might happen. But you're not going to be so scared and skeptical if it's something that you patronize from time to time. Do not come in here to gamble. Come in here to invest. The next thing you want to do is gather information. Let me tell you something, whatever is going to bring good returns needs some level of work. So you have to do your due diligence, whether you like it or not. Please, while you're doing this, do not listen to all those people that are sharing stuff on Instagram to buy this and buy that, because I feel that those people, they pay them to say all those things. I have listened to those people, I have lost money. Please do not do that. So the simple way that I get my information is, one, the annual reports that the company that I invest with sends to me. It's very detailed. You can take your time to go through it. Or the financial news that the investment platform shares with me every day. And then thirdly, you have the internet at your disposal. Turn it upside down. Get every information that you can out of it. There are some common mistakes that I made when I first started investing, and let me share it with you so that you can avoid them when you start your own journey. The first thing is investing for dividends. When I began to learn about investing, the first thing that was so interesting to me was the money that I could possibly make out of what I put into that market. So there were some times that I bought some stocks, and I bought it at the time that the stock was doing so well, and maybe their interest rate was so high. I felt that their interest rate was going to be like that forever. Like, one of the first stocks I bought was Enbridge. And when I bought Enbridge, their dividend yield was like 12%. Today, I think their dividend yield is like 6 or 8%. So you never can tell what will happen in the stock market. Things are always fluctuating. So that's why I say just buy something that you're comfortable with, buy something that you like, so that it will be like going to the market and getting a product or a service. The next thing is putting all your eggs in one basket. I used to buy so many individual stocks, but I have stopped doing that because it's not so easy going back every day to see how they are doing, to know if you take your money out of the market. So I stopped doing that, and now I buy mostly index funds. The next is investing with your emotions, which I talked about earlier. When you hear one thing online, all the crowd are saying buy this, buy that, buy this, buy that, and because of that you go ahead to buy it, and then at the end of the day there is a tendency you lose all your money. So invest with your head and not your heart. It's going to be ignorant of me to sit back here and say always invest with your head and not your heart, because we are human beings, you understand. Our emotions can play with us sometimes, which brings me to the last one, which is give yourself the grace when you make mistakes. That time I invested in Manchester United, and I saw that every month I was putting my money in here, but I'm not getting anything. Like, this thing what they do, they make me happy. So there was a point that I was like, oh, if this is what is involved in investing in the stock market, I don't do it again. I wash my hands come out. Maybe it's not just for me, you understand. But this was me. No research done, knew nothing about investing, but I was complaining like I had done any research or learned about it. After I lost all that money, that was when I came to the realization that you have to learn about this thing if you want to excel in this area. So I did a little bit of research, and as I was researching and learning, I was enjoying it, and I was doing it more and more and more. And now I can sit back firm if I lose so much money today, because I know that in the next 10 years I might get ×2 of that. Now, if you're thinking, I don't want to go into this stock investing thing and make mistakes and fail and blah blah blah, if you're skeptical, I have something for you. So there is an investment platform that can give you $50 to start off, like, not just to play with it. And that investment platform is called Trove. So if you click on the link below, you can register and start off with that $50 and play and see how much you can lose, how much you can get, you understand. And if it's something you're comfortable with, then you can go all into it. I personally feel that experience is the best teacher. So you can listen to me all you want, you can read all the books, you can watch all the videos, listen to all the podcasts, read all the articles, read all the news about stock investing. But if you do not start, you can never reap the rewards. So start today, start slow, and start small. I really hope you got value out of this content. Thank you so much for watching. As always, I will see you next week.